So the 18 million we sell the company for will only suffice to cover my stake.
And what happened to all the other people?
The most exclusive part of the business law.
Welcome back to Business Law Toolbox. And today we're going to talk about the 4 ways to get the investor to accept a higher valuation of your company. And for me, this could be a bit scary to negotiate with an investor, but also put the valuation on your company. Because if I'm speaking for myself, would put a valuation on my company, if I was supposed to sell it, it would be a lot higher because I put in so much work in it. But to look at the facts and what are the strategies for that?
Well, often you as the founder will want a high valuation, right?
Of course.
And you as the investor want a low one because then you get more of the company for the same price. So there is always a battle. That's normal. And what we're going to talk about now is strategies that are risk sharing. So we're not talking about tricking anybody to accept an inflated valuation or anything like that. We're talking about proper methods that are risk sharing, which means that they will entail a risk for you as well. In particular, if the high valuation that you're arguing for will not hold up. So if the value goes down, that will have an impact.
Of course. So the first strategy that you would recommend, what is that?
Well, that is that you and the investor can agree that you cannot agree on a valuation right now. Okay. So you can do a convertible instead. Because that's a hybrid, you can say, between a loan and equity, that is shares in the company. So what happens is that if I'm the investor and you're the founder, we say that, okay, it's too uncertain now really to pinpoint what value that this company has. So I will not invest in shares right now. I will provide you a loan, and then you have the opportunity to go for the next funding round, and I will convert my loan into shares in that next funding round.
Okay.
But I will only do it if you give me a discount. Because I take more of the risk, because I invest today and not later on when the development of the company is much more certain, right?
Yes.
So I want an interest component on my loan, and I want a discount of 25% when you fundraise.
Oh, so that comes when you're gonna give the money back next time, and then the investor gets shares.
Exactly. So you do not get money back. The investor never gets his loan back. Instead, he gets shares, and the loan is converted into an investment, into equity in the company.
Oh, then I understand.
Yeah, because as a startup, typically you cannot repay a loan, and you do not want that burden on your balance sheet, really.
Yes, but what could be the risk? I mean, what happens if you cannot pay or give shares in the company if there's been a bad time or something?
So imagine that you can't fundraise. You can't find any other investors. Typically, you will have kind of a penalty that if you do not succeed, because you sold this into me, right? You said you're going to fundraise and it's going to be a high valuation and no problem. So if you fail within, say, 12 months, then we can have a penalty conversion, which says that I get to convert into shares at a very low valuation, or we can decide that it remains as a loan, something that is less good for you and the company.
Okay, but it's like an emergency thing to do.
Yeah.
Okay, sounds a bit scary.
Yeah, but it's a possibility for you to get the investment now.
Yes.
And you don't have to accept the low valuation, right? Because you have the opportunity to prove your point. But it also comes at a risk.
Of course.
So that was number 1.
Number 1, and then if we head out to number 2, what is that?
Well, number 2 is that you can offer the investor an anti-dilution protection.
Okay, and what does that mean?
That means that if I'm the investor, I invest in your company today at a valuation of 100, say. Well, say 100 as a price per share, we can call it to make it easy. So then I get 10,000 shares for an investment of 1 million, right? because they were 100 per share. Yeah. But I say to you that I feel that this is quite high, this valuation, and I'm not sure you're going to make it to grow this company that you promise. So I want you to promise me that if the next funding round things go sour, so the valuation does not go up, it goes down, then I would be diluted, right? Because I entered it on a high valuation and then people come in at a lower valuation. Then I want you to promise me extra shares. So I'm compensated, so I do not get diluted.
Okay, it sounds very complicated, but I mean, it's a safety for the investor.
Yes, for certain.
So he don't lose money, he or her doesn't lose the money.
Exactly. So imagine that I got 10,000 shares for my investment of 1 million, for price per share 100. And then you do not manage to raise the value of the company. So instead, you do a funding round at a price per share of 50. So you slashed it in half. Then we will do a recalculation of my investment as if I had invested at 50. So we will take that million and divide it into 50 instead. So then I would have gotten 20,000 shares.
Oh, okay. Then I understand.
So I already have 10. Now I'm entitled to 10,000 additional shares.
Okay.
Now I'm going to make it even more complicated.
Thank you.
This is what we call the full ratchet.
Okay.
It's the most investor-friendly model. Because, I mean, first of all, imagine that you give 20 shares to your new CFO at a value of 20 per share. I shouldn't get any anti-dilution protection, right? Because, I mean, if we were to recalculate my whole investment based on that, I wouldn't get not diluted. I would actually grow my stake in the company, and that wouldn't be fair. So you can have it proportionate to what actually happens in the next funding round. You can say that there are only qualifying funding rounds, and also look at how much dilution would I as an investor really get. Because perhaps I should only get 5,000 shares or something like that. So the devil is in the details. But the basic structure is you get additional shares to compensate as if you entered into the company at that lower valuation.
Okay, to summarize it.
Yeah.
Okay, and that takes us to the next step. Step number 3.
Well, not steps. I'm going to call these alternatives, actually.
Alternatives. Alternative number 3.
Yeah, and you can combine them, but some of them you can combine. But look at them individually. And this one is you can offer the investor preference shares.
Okay, and what is that?
Typically in the company, you'll have common shares, one type when you start a company.
Okay, so there's different types of shares.
Can be, if you decide to have different types.
Okay.
So if you only have common shares, everybody will have the same control rights and the same economic rights. Okay. But if an investor comes and he's a bit uncertain if he's gonna invest or not, he might say that I want preference shares. And that, at its core, it only means that there is some difference between the rights of the shares. But in our example, we're going to go with the typical, which is that he will have a preferred right to all proceeds, that's cash, that comes from the company in a liquidity event.
Okay, does that mean that he gets more money, or how does it work?
Well, he gets his money first.
Okay.
And a liquidity event is you can sell the company, you can liquidate the company, you can go bankrupt, but then typically none of us would get anything. It can be you pay the dividend, depending on what you decide upon.
Okay, so the shares are different due to the different controls or for the company.
Economic rights in this case.
Economic rights, yeah.
So imagine that I invest 20 million and I get preference shares. And let's say that the company was worth 100, a valuation, post-money valuation of 100.
Yes.
So 20 million means I got 20% right of the company. But I get preference shares. And the company is sold at only 18 million.
Okay.
So if we had the same type of shares, you would get 80% of the 18 million. But since I have preference shares, I'm entitled to get my full investment, that is 20, back first. So the 18 million we sell the company for will only suffice to cover my stake.
Uh-huh. And what happened to all the other people?
Exactly. So if we both had common, then you will get 14.4 million, right? 80% of the proceeds. But in this case, since it doesn't even cover my 20 million, I will get 80 million and you will get 0.
Wow.
So there's a huge difference,
Okay.
right?
Is it a common problem that it ends up like this?
Yeah.
It is?
It's very usual that the investor requires preference shares.
Mm-hmm.
And if the company goes well, it won't be a problem. This is only a problem if the valuation goes down.
Okay.
Mm?
Preference shares.
Preference shares.
Okay. And that takes us to the next method, which is?
This is number 4.
Number 4?
Yeah. We can offer what typically is called second closing option. And that is that when I invest at for me, in my perception, rather high or uncertain valuation, I get shares for my investment, but I also get warrants that entitle me to convert or buy extra shares in the future at a predetermined price that can, for example, match the price of my investment. So what that happens is that I get to wait and see for part of the investment, right?
Mm-hmm.
So I put part of the money in now, and then I can wait to see if the value actually grows. Then I can put in additional money by using the warrants, but at the same price per share as the shares I got today. So that's also kind of risk sharing between the founder and the investor.
But it's also a way to negotiate to start an investment.
Yep.
Okay. Now we have 4 different ways of negotiate with your investor.
Yeah.
Um,
And my recommendation is that if you're either thinking about trying to suggest something like this, because you can't really get a yes from the investors, because this is where you really want the money and you cannot get it otherwise. Or if the investor comes and imposes this on you, that you should really, really, really look at the details and do a worst case and a best case scenario. So really check, okay, what happens if the valuation goes down by half? What happens if we will not fundraise within 12 months? So make sure you have tried and tested so there's no unpleasant surprises in the end.
okay. Thank you so much.
Thank you.
So,
And happy to do a special segment on each of these because
yes.
there are so many varieties in them.
Yeah.
Good to know.
So this was the episode of 4 ways of getting the investor to accept a higher valuation of your company. And I want to say thank you for explaining it so well. It's very complex.
And happy to do a deep dive into each of them because this is like a general what you need to know.
Yes.
To kind of navigate the investor and the lingo and the negotiation.
Yeah, because it's a big thing to get investors in your company. I mean, for me, it feels a bit scary to talk about these if you want to invest in your company.